Here's something that catches the most business owners off guard. You've worked hard, built your company, and now you are making good money. So you transfer funds from your business accounts to your personal account thinking 25% company tax is all you owe. Then tax time rolls around and you discover suddenly you are facing penalties you never saw coming. The truth is, paying yourself from a company structure isn't as simple as moving money between accounts. There are 3 legit ways to do it, and getting this wrong can cost you thousands in unnecessary tax or compliance issue. I'm Krishan Sharma, a chartered accountant and founder of KNS Accountants. And one of the biggest mistakes I see business owners make is treating their company bank account like their personal wallet. So in this video, I'm going to walk you through 3 ways you can legally pay yourself from a company structure, including salary or wages, dividend, and even company loans. By the end of this video, you'll understand exactly which approach gives you the best tax outcome for your situation and how to stay fully compliant. Let's get into it. Before we dive into the 3 methods, let me address the elephant in the room. Most people register a company because they hear companies only pay 25% tax. And that's true, but they think, great, I'll pay 25% tax on my profits, withdraw the rest, and I'm done. That's where the problem starts. Your company is a separate legal entity and is basically treated as a person in eyes of the law. It has its own tax obligation, bank accounts, and liabilities. So when you make money out of a company, you are not just withdrawing your own money, you are taking money from a separate entity. All of a sudden, the tax office wants to know how you are planning on taking that money. Is it through a wage, a dividend, or a loan? Each method has different tax implications, and if you don't structure it correctly, you'll end up paying far more tax than you need to. Or worse, you can find yourself in breach of Division 7A. Let me show you the 3 ways to do this properly. Method 1. Salary and wages. The first and most common way to pay yourself is through salary and wages. This is exactly like being an employee, except you are employing yourself. Here's how it works. You work in the business and the company pays you a market rate for the work you do. This means the company needs to pay your PAYG on your behalf, contribute your tax at the current rate of 12%, pay workers' compensation insurance. Now, why would you choose this method? The biggest advantage is protection. If you are in a high-risk industry like construction, being paid as an employee means you are covered by workers' comp insurance. If you get injured on job, you are protected. The second advantage is simplicity. The company pays the tax as you go, so there are no surprises at tax time. You also build up your super, which is a tax-effective way to save for retirement. And here's the best bit. The salary you pay yourself is tax deductible for the company. So if your company makes 200,000 profit and you pay yourself 100,000 in wage, the company only pays 25% tax on remaining 100,000. But there's still a downside. If you are on a higher wage, you'll pay higher personal tax rates. In Australia, once you earn over 190,000, you pay 45% tax. So at higher income levels, wage alone might not be most tax-effective strategy. Method 2. Dividends. The second way to pay yourself through is dividends. This is where the company distributes profit to its shareholders. Now, here's where it gets interesting. Dividends can be franked or unfranked. Let me explain franked dividend first, because this is where the tax benefit really comes into play. When your company makes a profit, it pays 25% company tax. So if your company makes 100,000 profit, it pays 25,000 in tax, leaving 75,000 after tax. Now when you take that 75,000 as a franked dividend, you also receive a franking credit of 25,000. So on your personal tax return, you declare 100,000 as your income, but you have already paid 25,000 tax through the company. If your marginal tax rate is 37%, you only pay the difference, 37 minus 25%, which is 12%. So you only pay an additional 12,000 in personal tax. The biggest advantage, if your marginal tax rate is lower than 25%, you can actually get tax refund. This is why franked dividends are also powerful for tax planning. Now, unfranked dividends are different. These are paid when the company hasn't paid tax on profits yet. So you receive the dividend, pay your full marginal tax rate on it. The key thing to understand about dividend is that they are distributed based on shareholding. So if you own 60% of the company and your spouse owns 40%, 100,000 dividend would split into 60,000 to you and 40,000 to your spouse. This is where tax planning becomes important. You don't want to give dividend to a person who's already sitting at the highest marginal tax rate because they'll pay more tax on it. The downside of dividends, you can only pay them from profits and you can only distribute them in financial year after the year the profit was made. So there's a timing issue and you can't just pay yourself dividends whenever you want. Method 3, company loans, Division 7A. The third method is taking a loan from the company. Now this is where things get tricky because of Division 7A. Division 7A is a rule that says if you take money out of the company and it is not a wage or dividend, the ATO treats it as a loan. And if you don't set up the loan properly, the ATO can deem it an unfranked dividend, which means you pay your full marginal tax rate on it. If you choose to go down this path, you must get a written loan agreement. This isn't optional. And the agreement must specify the loan amount, the benchmark interest rate set by ATO each year, the repayment schedule, either 7 years for an unsecured loan or 25 years for a secured loan. You also need to make minimum annual payment including interest. If you don't make those repayments on time, the ATO can treat the whole loan as an unfranked dividend in that financial year. So when would you use a company loan? Well, short-term cash needs are the best use case. Cash quickly. You don't want to pay extra tax and you don't want to wait until the next financial year for a dividend. A Division 7A loan can give you access to that cash. But here's the problem. The compliance is complex and costly. You need to maintain the loan agreement, make regular payments with interest, and if you slip up, you hit with a big tax bill. We generally advise clients to avoid Division 7A loan unless there is a really good reason. And if clients aren't consistent with their repayments, we often flush the loan out as an unfranked dividend at the year end, just to avoid the compliance headaches. So while you have those three options at hand, if you want to pay yourself through your company, there's actually another strategy you can use. One we use the most of our clients, and that's the combination of wages and dividends. Why? Because it gives you best of both worlds. You get the protection and simplicity of wages plus the tax efficiency of dividends. Here's how it works in practice. Let's say your company makes 200,000 profit for the year. You might pay yourself 80,000 in the wages throughout the year. This covers your living expense and keeps you covered by workers' comp. At the end of the financial year, the company has $120,000 left after paying wages and other expenses. The company pays 25% tax on that, which is 30,000. That leaves 90,000 after tax profit. Now, you could leave that in the company as working capital, but if the company is building up cash reserve beyond and what it needs, you might choose to distribute some of that as franked dividends to yourself and your spouse. This is where tax planning becomes even more powerful. If your spouse is on lower tax rate, you can distribute more of the dividends to them, reducing your overall family tax bill. And because you are taking part of your income as wage and part as dividend, you are smoothing out your tax rate. You are not paying the highest marginal rate on everything, but you are also missing out on super contribution or workers' comp protection. This is why we sit down with our client during tax planning season, usually in May and June, and work out optimal split between wages and dividends based on their personal and business goals. So there you have it, the 3 ways to pay yourself from a company structure and why the combination of wages and dividends typically gives you the best outcome. The key takeaway here is this: your company is not you. It's a separate legal entity and how you pay yourself matters. Get it right, you'll save thousands in tax while staying fully compliant. Get it wrong and you could face penalties, higher tax bill, and a lot of stress. If you are unsure which method works best for your situation, or if you want to make sure your current structure is optimized, this is exactly the kind of planning we do at KNS Accountants. We sit down with you, look at your numbers, and structure it in a way that both tax efficient and compliant. I've left a link in the description if you'd like to book a consultation with us. Otherwise, if you found this helpful, make sure you check out my next video. See you in the next video.